With markets left reeling from Donald Trump's tariff announcements midweek, we're entering a new week with a renewed focus on the economics as people try to gauge exactly what the direction of travel is for the US economy and what the fallout will be. When it comes to the US dollar, it's been very clear. When it comes to equity markets, it's been very clear. Will those trends last? Well, let's look at the week ahead for the week starting the 7th of April to try and gauge exactly what the main movers will be in terms of the economic data. So first and foremost, let's look at the big ticket items as we always do. This is according to Trading Economics, and in actual fact, I've had to sneak in one item that they don't deem to be important. For some reason, the RBNZ interest rate decision every month they put as a mid-level release. Nonetheless, of course, we're going to be looking at that. And so we have, for the course of the week, trade data out of Germany on Monday. We've got a focus on Australia on Tuesday with the Westpac consumer confidence and business confidence. The IV PMI coming out of Canada. That interest rate decision out the RBNZ on Wednesday morning, consumer confidence out of Japan, and then the FOMC minutes on Wednesday evening. On Thursday, inflation data coming out of China, and then we have inflation out of the US. This is going to be the big ticket item for the week, leading us into Friday. We've got a raft of data out of the UK, and topping off the week with the PPI inflation metric and the consumer sentiment figure out of Michigan. So let's kick off with a focus on the US. And certainly, of course, right now, everything is US centric. The enactment of these widespread tariffs appear to be in the name of strengthening the US economy. But in actual fact, it's likely to do as much damage to US businesses as it is to those abroad, because you're looking at the possibility of a major slowdown in the US economy. You're looking at increased prices of goods coming into these producers. You're looking at, say, the collapse for Nike. Their products have been created abroad. What do? Do they suddenly have to bring that process back to the US? They'll pay much higher wages. Their margins will be poorer. They ultimately probably have to raise their prices more. It's a difficult situation. The globalization that has benefited so many companies within the US markets appears to be coming to an end. And so, this is a particularly tough time. And that's why we continue to see weakness in terms of equity markets. Now, in terms of this week ahead, we've got on the 9th, we've got the FOMC minutes. Of course, the key question at the moment is, will the Federal Reserve look through inflation that is tariff-based and continue to ease off the back of that? That's what Jay Powell did insinuate would be the case. But, you could see a short-term bump in terms of tariffs, but tariffs lead to the need for higher wages to pay for the higher price goods. Higher wages lead to higher costs for businesses. It gets passed on to their output. Those outputs can go to another business. They might have to raise their prices. So it's not necessarily a one-off. A jolt in terms of inflation can then permeate with a sort of ripple effect throughout the economy. And so maybe the Federal Reserve might not necessarily be as sort of gung-ho when it comes to easing as people might believe. Now, inflation, of course, is key this week because on Thursday, we then see the CPI numbers coming out. There's an expectation we see 0.3 on the core monthly, 0.1 on the core headline. So weakness in terms of the near-term inflation metrics on a monthly basis expected. That driving down the core and the headline, 2.5 on the headline, 3% on the core. That's what's expected this time around. Notably, whilst you have the fears around inflation sort of indicated by tariffs, you also have that potentially offset to an extent by economic weakness, right? If people are fearful within the US economy, or, we've seen consumer confidence slump, or businesses hold off on investment decisions, or people get laid off, these are the kind of things that ultimately could drown out some of the demand and lead to lower inflation. So you do have that element coming into play. But nonetheless, what we're looking for here is, do we see that initial tentative sign of a sort of resurgence in price pressures? And would that do anything to the Fed, right? So what's the FOMC minutes coming out on Wednesday? What's the inflation gauge coming out on Thursday? by and large, in terms of market sentiment and market expectations, they expect to see inflation in the US relatively subdued. So when you're looking at the sort of precursor to the tariffs, what we've been seeing is a lot of uncertainty, people probably holding off on investment decisions and the like. I wouldn't necessarily say that it's too inflationary. We have seen inflation rearing its head within the manufacturing sector. That's been notable. And so whether we sort of follow that up and whether we see sort of goods prices start to rise, that remains to be seen. Also look out for that Michigan Consumer Sentiment Survey, because alongside the consumer sentiment, you also see inflation expectations and alike. So certainly that's going to be a key thing to be watching out for as we look towards the new week. Now, in terms of some of the charts, you can see inflation by and large has been sort of trading sideways. You can see in terms of the levels in question here, we're looking at headline CPI 2.8, core CPI 3.1, core PCE 2.8. Right, so those are the kind of levels we're dealing with, the upper twos, the lower threes. Of course, we need to get back down towards that 2%. But there's a fear that this is going to rise once again, and particularly rise even before we see those tariffs kick in. And we can see that here. So these metrics are all 6-month annualized. It means take the last 6 months and pretend that's happened for a year. So what would be the annual rate if you just look at the last 6 months? What that does is essentially strip out the older stuff that isn't as important and gives you a more relevant near-term picture. And you can see here most of these moving towards the upside of late. So certainly we have been seeing some signs of a resurgence in terms of price pressures, even leading into these tariffs. So whilst the Federal Reserve might say, you know, if we see a tariff boost in terms of inflation, we'd be willing to look beyond it if the economy needed it. At the same time, you could say, well, even without the tariffs, we are starting to see some upward price pressures coming into play for the US economy. In terms of the sort of breakdown for the CPI figures, we can see that ultimately, like I said, we're sort of grinding higher. Then we ticked a little bit lower last month, 3.14, 2.8. You can see the month on month, 0.227, 0.2. So not necessarily anything too troubling. But if you look at the prior months, we were looking at very elevated figures for a decent amount of time. You know, the July figure was the last time that we saw figures that were similar to last month, to the February ones. And aside from that, you're looking at a good 6 months worth of elevated inflation. And when we see those low figures, so, you know, we've been talking for a while about the idea of, you know, in February, March and April, we'll get stripped out and we get serious disinflation. And that still could be the case, right? If you look at March from last year, the base effects of stripping that out and adding in a relatively low figure means that we do see disinflation, or the potential for it. And that's why, you know, markets are expecting to see headline inflation down to 2.5 from 2.8. So you see a potential good news story there. And then next month, you could also see a bit of disinflation, you know, if you see the same kind of thing. And if tariffs don't necessarily show up in it immediately then. But then you're looking at the base effects for May and June, and they're not great. And that comes at the same time that we're really seeing the tariffs kicking in a mean way. So April likely to see tariffs kick in. May's also likely to be showing it up heavily. And then, you know, that essentially is the bottom, right? So the bottom is likely to be either this month's reading or next month's reading because of these base effects of last year's monthly figures being stripped out. And from then on in, you know, it's just likely to be on the rise. And that is something that markets are likely to be fearful of. It's the kind of thing that's going to put pressure on the Federal Reserve to state exactly where they stand in this. You know, the Federal Reserve and central banks as a whole, we shouldn't be in a position where they're going to say, we're going to cut rates irrespective. You know, they won't be. They need to be data dependent because that's what the name of the game is when it comes to being a central banker. Now, in terms of the equity markets, let me just bring this up here. So this is the Dow Jones Industrial Average. I say this is, well, there's 4 here. So the candlesticks are the Dow. I wanted to show you some of the other markets. The Nikkei 225 has been underperforming with US markets because of the strength of the yen. But we've been seeing a resurgence in terms of the Hang Seng and the DAX, both peaking out recently. And now all of these markets are rolling over. So that sort of honeymoon period, I guess you could call it, that period of strength for Asian equities, for mainland European equities, around the idea of increased stimulus, around that fiscal spending package outlined in Europe in terms of defense. That's all fading now. And now instead people are worrying about what's going to happen in terms of their exports, how the global economy could slow down, and essentially, the deterioration of global growth at the hands of Donald Trump in the name of trying to get some jobs back into the manufacturing sector, despite the fact that the US has relatively low unemployment anyway. It's not like they've got millions of unemployed, highly skilled manufacturers lying around the place that really need to be sorted out. Anyway, the US consumer is going to have to pay for it. And so if we strip out those other markets and let's look at the Dow in its entirety, you can see here we've got this double top formation that we're now sort of exiting from. The long-term trend is, of course, a very bullish one. We don't necessarily know how big this retracement is going to be. If you're to utilize the technique of measuring from the neckline up to the head, let's just, there you go. So, wait, up there. So 3342, you project it lower, you're roughly around there. So that would be, I want to go on to the regular chart. So that would be taking us down to sort of 384s kind of area. I mean, you're talking about the possibility of a significant amount of further downside. Now, if we were to look at it as a retracement of this wider move, you'd be looking at potential support levels of 39087, 40232. For the near term, of course, the key support level here is already being challenged, which is at 40653. And if we break down below that level, then you're looking at sort of continuation of this current weakness. And I do think that's likely. I mean, look, if you're looking for the good news stories, what's that going to come in the form of? It could come in the form of one thing only, and that is trade deals and talk of dropping these tariffs. And aside from that, where's the good news going to come from? Because you're looking at the possibility of a weakening economy, the possibility of higher inflation, the breakdown in terms of global trade, the breakdown in terms of global growth. There's a huge amount of implications that go hand in hand with these announcements. And, Donald Trump doesn't sound like he's thinking that they're just going to be a tool with which to lower tariffs from other countries, because he's not even enacting reciprocal tariffs. He's enacting tariffs based on the trade deficit, which is a lot harder to get past because the other country isn't going to drop their trade deficit. So it's difficult to see exactly where we're going to go here in terms of seeing a major rebound unless Trump starts to pull some of it away. And you could say that he started from a very stringent line and then you start to sort of whittle it away from that. And that may be the case. But certainly from a bullish standpoint, the one thing we need is for trade deals to start happening. And you could say that, we were promised retaliation from the EU and Canada and the like. We haven't heard it yet. It doesn't mean it's necessarily not going to happen. But if we start to see an approach where it's more a case of working together to try and remove these and to strike trade deals, then that's when we could see the balls come back into play. But that's all a very long-winded way of me saying I think we could very easily break through this 40653 and continue on this bearish trajectory as we follow through on the double top formation that we have been seeing to the downside. Support 40232, 49087. Next up, let's look at the New Zealand area. And like I said, we've got that rate decision on Wednesday. Crucially, that rate decision comes with a view that we're going to see rates steady. And, the RBNZ has been cutting rates at a relatively rapid clip. Apparently, that is going to draw to an end this time around. Now, in terms of the recent trajectory, we've gone from a peak of 550. And over the course of 4 meetings, we've gone from 550 all the way down to 375. So they mean business. They've been cutting at 25 basis points at a time. But now there's a possibility we pause. And now this could just be a case of uncertainty, tariffs. Maybe we'll just want to see the lay of the land and see how things play out, but arguably they could do the opposite, right? So in terms of the sort of outlook for inflation appears to be relatively tamed now. The last 2 months were sort of 0.63, 0.55. They're marginally above the level needed to get to 2%, but they're there or thereabouts. They're pretty much at 2%, a little bit above that. The 1 quarter annualized is 2.2, the 2 quarter annualized is is 2.4. The year-on-year figure is 2.2. So it's all around in the right area. In terms of market expectations, you can see here that we're actually getting a very different outlook on the Refinitiv platform compared to expectations according to trading economics, which is really important because, of course, trading economics will be what many sort of retail traders are looking at without necessarily getting this platform. This platform is a, let's just see if we can try and, just going to bring it up in a different, this platform costs a decent bit of money, and therefore you're looking at it to be kind of thing that most retail traders don't necessarily have. But of course, I can provide you some insights to it. So it's pointing towards a 25 basis point cut. And so, I did just check. The Forex Factory points towards a 25 basis point cut. So there's a lack of consistency in terms of expectations according to economic calendars. But according to this, we're looking at another 25 basis point cut. It comes off the back of repeated 50 basis point cuts. So it's a slowing down, but nonetheless, beyond that, there is an expectation that we see another rate cut the meeting after that, and then we potentially start to slow. You possibly see another rate cut in August. And so markets are looking to try and find where that sort of terminal rate is, so to speak, or the neutral rate. Essentially, I don't need to keep cutting rates until it hits zero, right? But they need to find the right level. And so when you look further out, markets aren't as convinced. But as you get closer to that supposed neutral level, then the bank's going to be telegraphing a lot better exactly where they see the that neutral rate lying. So in terms of the market that I wanted to bring up here, it was the New Zealand dollar against the Japanese yen. The yen at the moment playing a key role of haven in the absence of the US dollar, which continues to move towards the downside. Now, as we can see here, let's just go to the monthly time frame. You can see here that we sort of been moving lower, but it comes from an area of resistance that's been really sort of notable historically. You can see here, this is zone of resistance. We've popped into it, into the top end of it, and now we've been reversing ever since. So that high coming in July 2024, and we've been sort of weakening since then. The daily time frame shows you that it's relatively sort of calm and clear cut in terms of this recent trajectory. We've rebounded, but we haven't broken out through this near-term swing high, which is 87407, and above that we've got 89704. So these sort of stepped moves. So we've rallied, consolidated, and now we're sort of making these gradual lower highs and lower lows in play. So if we see that rate cut coming from the RBNZ, then we're going to be looking out for commentary to point towards exactly where that terminal rate is. But right now, the yen is kind of coming into strength, and so I wouldn't be surprised to see further downside playing out as market jitters continue, but people move out of the US dollar as a haven. It puts the yen in a position where it can take that role, and therefore we can potentially see further downside playing out for the New Zealand dollar against the Japanese yen. And then finally, let's look at the UK area. Of course, the UK was hit with 10% tariffs from Donald Trump and his crew. Ultimately, the UK doesn't have a trade surplus with the US. So the formula broke down on that occasion, but they still decided to whack 10% on the UK. Nonetheless, there's an argument here to say that the UK could do well out of this. Of course, this benefits US producers more so than international producers and exporters. But if the UK exporters are getting hit by a 20% tariff and mainland European producers being hit by 20%, all of a sudden you're more competitive than any other European product. The same kind of thing against China and places like that around the world. So arguably on a relative basis, as an exporter into the US, the UK just became more competitive on the price terms. Against US products, of course, that's not the case. This week ahead, we have got a raft of data coming out. We've got the GDP figure on Friday, which probably provides the sort of headline numbers for this. So you can see year-on-year figure for February, expectation we're going to drop down to 0.9. We've got the monthly forecast for February to come in at 0.1. Of course, recently we saw the spring statement where we saw the OBR slash their outlook for the year from 2% to 1%. People probably think that's the right move considering exactly how sentiment is going right now around global growth. Aside from that, of course, we've got the trade balance data, industrial production, manufacturing production, a whole host of, and that forward-looking NIESR monthly GDP figure. So a whole host of data points to be looking out for. Now, notably, in the past, when we've seen strength in terms of the UK economy, it generally helps the likes of cable. Weakness generally leads to a weakening of cable, and that, by and large, has been playing out recently as well. I mean, ultimately, when you see strength in terms of the UK economy, you would think you're seeing strength in terms of the global economy. That would lead to less demand for a haven such as the US dollar anyway. Of course, we don't necessarily have the services PMI this week. We've instead got GDP. But I just find this is a good chart to highlight that relationship between the strength of the economy and the strength of the pound against the US dollar. Now, it's notable that we've been seeing an almighty surge in terms of the pound against the US dollar, but ultimately it's a collapse of the greenback. And it looks likely that it's going to continue for the time being. It certainly has been continuing pretty heavily. So let's just bring the chart up one more time. And we will go on to not dollar yen. Oh, no, we're supposed to be bringing up cable. Okay, let's just bring it up here. Gold with a nice spike back. So let's bring up cable. So here we go. Monthly time frame looks like that, right? So the long-term trajectory is bearish, but we have been in this recovery phase for some time now, since the lows that we had back in 2022, and more recently with on 3-month sort of push. We're into the 3rd month push higher for the pound, ultimately against the dollar, which has very clearly been heading sharply lower of late. Let's go on a 4-hour chart, but you can see here this is the US dollar. This is cable. You can see how much of it is driven by, let's just invert that. How much of it's, oh no, we don't want to invert both of it. We want to move this one to a new right scale, let's say. So we can invert either of those. There you go. So this highlights how the relationship and the trajectory of cable is primarily just a case of what's the trajectory of the US dollar. So, we could put on, say, euro dollar as well, and the same kind of thing, right? Euro dollar, but we've got to reverse it. Anyway, long-winded, but there you go. It's the same thing. So this is primarily a US dollar trade that we're looking at the moment. So if you're looking at strength in terms of the US data, the UK data, yes, that could provide some strength for the pound, but ultimately, it's the weakness of the. Let's just get rid of that, and then we'll invert it again. Let's get back to square one. It's the weakness of the US dollar that's really taking hold at the moment, and part of that comes down to the US 10-year and the continued declines on that front. So we can see here, if we invert that, there we go. So you can see that close relationship. And so the weakness we're seeing in terms of the 10-year, so borrowing costs in the US, in line with the weakness of the perceived weakness of the US economy, the perceived expectation that the Federal Reserve is going to ease, things like that, all of that driving down the US 10-year relative to some of these other 10 years around the world. And so that's provided the basis for downside for the US dollar and strength for the likes of cable, the likes of euro dollar. So that looks likely to continue for the time being. And certainly if we're looking just on a pure price action perspective, you've seen this breakout recently, very shallow retracement and then pop into the next move higher. Of course, we saw the tariff announcement and the likes. You might say markets are selling off, everything's selling off, even gold's selling off. Well, it started to pop anyway. But why is the US dollar weakening? Well, as long as the 10-year is moving lower at the moment, that is driving the likes of the pound, the likes of the US dollar lower, and that helps lift cable, euro dollar, drives dollar yen lower, you name it. But certainly at the moment, that trend looks likely to continue. So keep an eye out for the US 10-year yield. That is certainly something that I think Donald Trump has an eye on as well, because he needs to roll over a significant amount of debt this year. And so he needs to bring down borrowing costs. So that's probably part and parcel of the whole plan over there. Bit of a shock and awe tactic. And certainly it's driving down the 10-year, but that's helping to drive weakness in terms of the US dollar. And that means that we do have a strong chance that we're going to see a continuation of the strengthening of cable that has been taking shape over the past 2 and a bit months, as we head into a week that, of course, has CPI data coming out of the US, but also has those GDP numbers, industrial production and manufacturing production out of the UK on Friday. So another busy week ahead. Look, ultimately, these economic data points can be interesting, but equally, the perception of how important they are or aren't will be really interesting this week, because markets are reacting to data that will reflect a pre-tariff phase. And so if, for instance, inflation stays subdued, instead of thinking, great, inflation is under control, markets are likely to think, well, we could still just see a pop of inflation next time around. Whereas if inflation pops, then it's like, wow, it's already rising ahead of the tariffs. This is awful. The same kind of stuff in terms of the sort of economics. So if we see weakness in terms of the growth stories, jobs data and things like that, then you think this is what it's like even before the tariffs kick in. Whereas if things are going well, then markets are likely to disregard it and say, well, this could change next month when the tariffs are showing up in the data. So right now, the question mark of whether markets care or don't care about this data is likely to come out in accordance to how the data is released, right? If it comes out strong or weak, that's likely to inform how much the markets care about that data. So a very interesting point in time indeed, and we'll make sure to keep abreast of all of these different situations as they play out here at Scope Markets. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Make sure to like and subscribe for more content like this.